Good morning everyone, this is Abid Khan and you are watching Karachians Academy YouTube channel. We have started a series of videos and lectures on past papers and we have selected CIE past paper of AS level accounting 9706, paper 1, which is multiple choice question based paper, and it's version 2. So we have selected May-June attempt, which is the latest one attempt of 2022. So we have done with couple of questions till question number 12 we have done. Today we will start question number 13. So let's move on to question number 13. This is your question number 13. What it says, a business owner does not maintain a full set of accounting records. At the end of the financial year, the following information is available: trade payables, opening and closing, and return outwards, and payment to the trade payables. Actually, it has given you a complete detail of the a trade payable account, and what is there were no cash purchases, right? No cash purchases. The opening and closing inventory has remained the same. Opening closing is same, no change. What was the amount of the cost of sales? Okay. So we have to calculate cost of sales. So you just do one working. All the things of trade payables are given to you, and you can find out. You already have gone through incomplete records chapter, right? So there we can find out the missing figures. So we can find out the missing figures of the purchases not given here, but we can easily calculate it. So if you say this is a trade payable account, its balance BD is, opening balance is 22,500, closing balance is 27,000. So 27,400 is closing balance. Closing balance, or you can say balance CD, 27,400. Returns outward, you know what entry we make when the returns outward means purchase returns. Here we debit trade payable and purchase returns are credited, whatever the amount is there. If it is 1,000 trade payable will be debited and purchase return will be credited. So 1,000, so your trade payable account will be debited. So trade payable account debit against purchase returns, right? I am making it short because this is MCQ based, so you do not have to provide all the workings. This is just for your better understanding and the building up of your concept. This one is done, and returns outward we have accounted for. Payment to when we make payment, what is done? Trade payable debited with 110,600. Your bank will credit it with 110,600. So this will appear here as 110,600, and you have paid it from bank. So you got all the information. So if you do total of this, is total, if you make total of this, so total of this will become 139,000. So total will become, if you deduct from 139,000 this 25,000, this balancing figure would come to 116,500. So this will be your purchases. Because what entry normally is made for purchases, we know purchases are debited and trade payable is credited. actually this entry is made at the time of credit, recording a credit purchase. So in credit purchase, your trade payable gets credited against purchase. So you have worked out these purchases, and these are the purchases. There are no cash purchases, only credit means total purchases. These are your total purchases, and we know how to calculate the cost of sales. Opening inventory, it is the same. If I say opening inventory is 5,000, this is just assuming, then you will add purchases. How much are purchases there? Your purchases are 116,500, and then you deduct purchase returns. Purchase returns are 1,000, and then you deduct closing stock, closing inventory. Your closing inventory will be 5,000. So this will be deducted, and this will be added. Both will be added. So how much would be actually plus minus is there? So opening closing has no impact. Only 106 out of this 116, 1,000 will be deducted. So you will get 115,600. 500. Sorry. 116,500. 115 and 500. So this will be your cost of sales. So cost of sales 115,500. Your answer will be C, right? Then move on to next question, and next question is 14. Let me move on to the question number 14. What is required there? Question 14. The provisions of Partnership Act apply if partners do not draw up a partnership agreement. This we know well, because in partnership, partners have to draw up an agreement. So which could be a verbal, or should if ideally it should be in writing. So there should be, so that no dispute arises, and if any dispute arises, that should be resolved in accordance with the agreement they have reached on, right? And in case if there is no agreement, then the government has made and it has published and promulgated Partnership Act. Though this is very much clear instructions from government that if there is no agreement, then the partners, for any dispute or for any activity, they have to follow the Partnership Act. So what Partnership Act says? So the partnership agreement is detailed agreement where you decide about the profit sharing ratios, you decide about the drawings and the interest on drawing, you decide about the interest on capital, salaries, all these things you decide, and you do accordingly. But what partnership allows you, only the partnership in case of any allowed by Partnership Act. So Partnership Act allowed only two things to you. Number one, they say if there is any profit and loss, whatever, if there is no agreement in place, then share equally. Number one, the profit or loss, whatever is there. Number one, and number two, it only second thing which Partnership Act allows you is 5% interest on loan. If any one of the partner has extended a loan to the partnership, so he will be entitled to 5%, because borrowing a money is a normal course of business. If partner do not extend those loan, then ultimately the partnership business will move to procure or to obtain that loan from the general market, and it will pay interest. It is normal practice. So that is why, and this is a business expense, right? So this is a business expense. That is why the partnership allows it, act allows it, and but it has given a certain percentage of and what is not allowed. What is not allowed under means only these two things are allowed, and rest nothing is allowed. Means salaries to partner not allowed, interest on drawings not allowed, interest on capital not allowed, right? And profit and loss distribution, they have to be do according to this. So let's move which statement is true. As a provision of the Partnership Act, in A, interest on drawing is charged at 5%. So interest on drawing is already not allowed under the Partnership Act, right? Interest on loans from the partner, yeah, this is interest on loan is allowed, but they are saying 8%, while the Partnership Acts allow you only 5%. So this is also not applicable. Partners are not entitled to salaries. This is very much right, because partners, they are not allowed, salaries are not allowed. And profits are to be shared in the fixed ratio. No, profits are to be shared in equal ratio. So this is also wrong. So your answer is C. So let's move on to next question. 15. What 15 says? Just 1 minute. Okay. Dua and Noor are in partnership sharing profit and losses equally. So they are equal partner. They admitted Z, Newman, now share profits and losses in the ratio of, this is change of partnership. One partner is coming. So there is a change of partnership sharing ratio from equal ratios to change to 2 to 1, right? So on admission of Z, tangible assets were reduced in value by 20,000. This is reduction. So this reduction in asset, this is basically a downward revaluation. So new partner has nothing to do with it. So this needs to be borne by the old partners, right? So this we will distribute them, and what will, when revaluation, upward devaluation is there, then your fixed assets increased and your equity or your capital increases, and we create revaluation reserves, or we charge credit to the partner's account. This is not company, this is the partnership. So fixed assets will be debited and their partner's account will be credited. Benefit will go to them. If it is a reduction, then this will be a loss. Loss will be borne by the partners. So we can make it here this way. Okay, we can do it, or I can. Here I have more place. I can do it here. Okay. Tangible says reduced by 20,000. This I have explained you. The goodwill was valued. Yes, goodwill is valued at 60,000. So again, goodwill benefit will be given to the partners, and their account goodwill will be debited, and their account will be credited equally by 30/30, right? But was not retained in the book, and this was to be retained. So its written write-off of the goodwill will be in all the partners. The new partner have to bear it, because it will be enjoying the benefit of goodwill. So it has to bear the cost of goodwill. So this will be charged to them. So what was the net decrease? Noor's capital. So actually you have to tell about the Noor's. So no issue. We can make I am, so I am saying this is uh, first was Dua and Noor, Dua, Noor and Z. Z is a new partner. When there is a reduction in the assets, what will happen? The assets, the partners capital 20,000 will be debited and 20,000 assets will get reduced. So reduction in tangible assets. So there will be a reduction and the partners capital will be debited by 20,000, so they are equal partners, so 10,000 will come to Dua, will have to bear, and 10,000 he will have to bear. Nothing for Z. And then what happened? The goodwill was 60,000. So what entry will be made? So you are not supposed to make entry. This is for your concepts building and for your concept building only. So 60,000 goodwill will be debited at partners capital will be credited 60,000. So goodwill recognition or recognized 60,000, they are equal, so 30,000 will be given to him, his account will be debited, will be credited, and no benefits will be given to him. When the goodwill will be written off, so what entry would you make? All partners capital. Partners capital will be debited with 60,000 and 60,000 you will credit the goodwill. This will be the written off of the goodwill. So goodwill written off, goodwill written off. So this will be in this ratio. 2/5, 2/5 and 1/5. So no issue. So we can see, let me open up my calculator. So 60,000 divided by 5, 12,000. So 12,000 will be deducted from Z and into 2, and 24,000 will be deducted from him, and 24,000 will be deducted from him. So actually we have to give the impact on notes. So 20,000, 30,000 is increasing in their in his capital, and 34,000 is decrease. So 4,000 is net decrease. So your answer will be 4,000. So 4,000 is net decrease. Right? So your answer will be A. Right? Answer A option. Move on to next. We have done with. So now we will do question number 16. So guys, we will do question 16. We have to keep our videos very short, and so question 16 you will find in the next video. That's all for today. So if you have any doubt or any clarification, you can write to us and we will try to get back to you very quickly. Thank you very much and bye for now.